Hello, this is Rob and Mike from the McClellan Financial Group of Asante Capital Management, and this is ThinkSmart with TMFG. Mike, over the last couple of podcasts, we've had an opportunity to come clean on some of the mistakes we've made over the years. My ego's down a little bit after those two podcasts, and I thought we might today talk about some of the things that we have done right over the years. So when I say that to you, what comes to mind?
First one is when we started off with, you started off earlier than I did, but before Asante, we were with a company called Equion. And the head of the company then was a guy by the name of Mike O'Nairn. And we still talk to him every now and again, but one of the big things he pushed at that time was a balanced portfolio strategy. And that's where we sort of started this all off, is the idea that if you diversify and you use different asset groups and different geographical locations in a portfolio, you'll end up with a much smoother return.
So this was the early 90s. I started with Equion in 1992. And at the time, most investors in Canada were predominantly in Canadian equities and GICs, individual stocks, maybe some mutual funds. International investing wasn't out there very much. Templeton was, but no one else really. And, the concept of a complete, balanced, diversified portfolio was rather unique.
Yep.
We've kept that balanced portfolio in place today, and that's, 28 years. And it's interesting how over the years, everyone else sort of caught up to it. And today, no one would build a portfolio without including the U.S., international markets, bonds, real estate. Even over the years, emerging markets came into the portfolio. That was rather unique, and that probably didn't arrive until, I think it was probably Mark Mobius with Templeton, who had an emerging markets fund. So we started including that in portfolios.
Then there was hard assets that came on later on, real estate, oil and gas, minerals, things like that.
And it was interesting. You sort of learned over the years you probably didn't need the oil and gas and gold in the portfolio because we're in Canada and we have a lot of that in our stock market.
Yep. So it was good development of a portfolio strategy that's been taken on by the rest of the industry now.
What are some of the other things that you think we've done right?
One thing that we know, we talk about market premiums sometimes. And we talk value versus growth, and we talk small cap versus large and profitability. But sometimes we forget to mention the biggest one. That means the markets will outperform treasury bills. Stocks will outperform treasury bills over the long term. And out of all the different premiums we have, that's the most significant. And what it means is the more aggressive you can be on your portfolio, the better your long-term results.
So when you say aggressive, I always think, it sounds risky. But when we say aggressive, we mean going from a portfolio that's 50% in stocks, 50% in bonds, to maybe 60% in stocks or 70% in stocks.
Yeah, we found in the last few years, one advantage that you can add as an advisor is you can get clients through some hard times that they probably could manage on their own. So as an advisor, we should be able to have people not over their risk tolerance, but we should keep them at the higher end of the risk tolerance. And at the end of the day, that's going to provide them better returns and a better retirement.
Absolutely. Clients who have more equities in their portfolio that have worked with us for 15, 20 years have done quite a bit better than those who had less. What else? What are some of the other moves that we have made that were early and have been beneficial for our clients?
Well, probably about over 10 years ago now, we made a move to fee-based. And the whole industry has now become fee-based. It's the big selling point now. And the big thing about being a fee-based advisors is you can give advice that is truly for the client, because you're always working for who is paying you directly. And essentially, we're now being paid directly by the client. So it means that we can find the products that best fit the client, whether they be external or from a company, wherever it may be, the best product that's going to grow their portfolio at the best rate, we can find.
So there's no conflicts of interest.
No conflicts of interest whatsoever. If we found a product wasn't performing, it'd be both our best interest and the client's best interest to take that out of the portfolio. And there is no repercussions about it.
So even today, even though progress has been made and even though a lot of advisors are moving to that, if you go and work with one of the Canadian banks, you're probably going to expect to find most of the investments are their own products.
Many times, yeah.
That's still a conflict of interest.
Yeah, they still have the option of doing other investments, but just from what I've seen in my own personal experience, when I do see someone come in with a portfolio that's been designed by the banks, it generally does have a lot of their own products inside of it.
One of the other areas that I think has been interesting has been financial planning itself. Back when we started putting financial plans in place, or at least I did, as early as 1992. And that was just sort of the starting point.
Who was it? Was it McKinsey that had the first?
Well, not really. McKinsey had the risk profile. They had the fund of funds, the McKinsey STAR program. But there was a couple, I think Trimark had a financial planning program that was pretty basic.
Yeah, there was some early software from the fund companies that was a starting point. I'll put it this way. It introduced ourselves to the world of financial planning. And after that, many times you have to go further than that. And we went and found some companies that specialized in financial planning. We've been using Naviplan for probably close to 15 years now.
So I saw an article yesterday that said when you're introduced to a financial advisor, 70%, it was looking at the different bank-owned firms, and 70% promise the client a financial plan. Only 50% of clients actually get a financial plan, which means 50% of people are operating just with portfolio management and no plan behind it.
Yeah, it's been one of the core beliefs we've had that you start with a financial plan. This is the most important thing you can put into a client's financial success. Portfolios are important, but you need to have a plan to work with.
A couple of other things that come to mind for me. One was the whole risk profile business. And, early on, we made the mistake of we would fill out our clients' risk profiles for them. And, a few years after that, we started to realize that that wasn't right. What I would see is often clients would keep GIC investments outside of us because they felt we were too risky. And the investments we were putting them in had too much in equities. So they would hold these GICs to help boost up their fixed income. It's probably been 12 years now since we introduced Finametrica.
Yep.
And that is really where the client does the risk profile. And it was interesting because clients who were holding GICs, suddenly the light shone and we saw that they were actually really very conservative. And we hadn't acknowledged that when we first started working together.
Well, the problem was at first we want to make everything easy on the client, so we'd sit with the client in the meeting and go and help them through all the questions. But the reality is they shouldn't have help with the questions. It should be their true opinion. They don't need to be influenced by anyone. It has to be how they really feel.
And you actually, if you have a married couple, both of them need to do it separately. You don't want the husband or the wife to have influence in the other's risk profiles. I remember one time I was sitting with a client and I said, "It's amazing how similar your risk profiles are." And he looked at me and he said, "Well, that's because I completed my wife's as well." So it all suddenly made sense to me.
Yep.
And it turns out his wife was far more conservative than he was.
Yep.
Anything else that comes to mind?
Tax planning has been a big piece of the business that we brought in. We have a tax service now, so that's been over the last 5 years. But it was because clients really needed that. That was something we saw was lacking in the service that we were giving to people. People want someone to take care of their taxes. We started much earlier on than that, actually taking people's tax returns, taking a copy of them, going through the notice assessment, going through line by line. And the reason why we started to do this is we found a lot of errors. And mostly not the accountant's part, to be honest. Mostly it was the clients not giving the accountant the proper information. And we realized that if we can put ourselves in the middle of this process, we know a lot more details and we know what's needed to complete these tax returns. So I think that's been a very strong service that we've brought in the last 5 years.
The other thing I always think of is how important taxes really are. So most investors really like to focus on investment returns. And yet what they're forgetting is up to 50% of those returns can be taxable if those returns are earned in the wrong type of account or the wrong type of investment. And so if you're losing half your returns to taxes, it really didn't matter how good your return was. You're better focusing on your after-tax return, and that's really the key for portfolios.
Money saved on taxes is after-tax money in your pocket guaranteed, which is very tough when we look at getting advantages on the marketplace. We're looking at expectations of a return. If you can actually get money back in taxes that you were going to pay previously through legitimate methods, it's going to stick. It's money saved in your pocket.
So I think that's a pretty good summary today of things that we have done right. This is Rob and Mike with ThinkSmart with TMFG from the McClellan Financial Group of Asante Capital Management.
You have been listening to the McClellan Financial Group of Asante Capital Management Limited. Asante Capital Management Limited is a member of the Canadian Investor Protection Fund and Investment Industry Regulatory Organization of Canada. Insurance products and services are provided through Asante Estate and Insurance Services Incorporated. This material is provided for general information and is subject to change without notice. Every effort has been made to compile this material from reliable sources, however, no warranty can be made as to its accuracy or completeness. Before acting on any of the above, please make sure to see a professional advisor for individual financial advice based on your personal circumstances.